Hello, and thank you for joining us at xm.com. This is the Weekly Outlook. I'm Christina Marujos. I'm joined today by Marios Hadjikyriacos, Senior Investment Analyst, and of course, we'll be having a look at the upcoming week, which appears to be rather quiet regarding central bank meetings. However, it has a flurry of economic data coming up to keep investors busy, Marios. But before we get into that, let's talk about the theme of inflation, which appears to be not as transitory as the Fed suggested. The Delta variant continues to cause supply chains disruptions across the world, and it doesn't seem to be slowing down. Therefore, is higher inflation here to stay, for now at least?
Hello, Christina. Yes, I think so. So a few months ago, the Fed started playing with this idea that, yes, we're seeing prices go up, but that's because supply chains have gotten disrupted. But that problem is going to get resolved by itself over time as companies adapt to this new environment and as they expand their production capabilities, in a sense. Now, that hasn't really happened. So lately, we've seen shutdowns in several crucial economies in Asia. And as a result, if you look at several business surveys like the PMIs, for example, the theme is very consistent. Supply chain disruptions are getting worse. Companies are facing higher production costs, higher shipping costs, and as a result, they are passing a lot of that on to consumers in the form of higher prices. So I don't think inflation is going to cool, at least as quickly as the Fed thinks. And this idea of transitory inflation, it could quickly turn into slightly persistent inflation. And funnily enough, once supply chains finally normalize next year and this cost inflation starts to cool, that might be replaced with some good old demand-driven inflation. Because by that point, several economies, the US included, will be very close to full employment. So in an environment where workers also have a lot of bargaining power, the most they've had in decades, I would argue, and with globalization going in reverse ever since Trump took office, that's a cocktail that could keep inflation hot for a while longer.
I see. Now, let's turn to the data. The United States are expecting inflation numbers on Tuesday, followed by retail sales on Thursday. Given that markets are pricing in a Fed taper announcement in November, how crucial is this set of data going to be in determining whether the Fed will actually go ahead with its taper plans? And how will the dollar perform?
Well, this data is going to be absolutely crucial. So retail sales are expected to have fallen for the second straight month. Now, I don't think that's really worrisome because consumption exploded. It skyrocketed this past year. So it's more than natural to see some payback or some cooling now. I don't think that will scare the Fed. And inflation, of course, is expected to remain relatively hot. Now, as far as the Fed is concerned, you're right, everyone's expecting a November taper announcement now. For that to happen, we probably need to see one more strong US jobs report. And in the bigger picture, I think that this keeps the outlook for the dollar positive, especially against the euro, because we're in an environment where the Fed will almost certainly normalize much faster than the European Central Bank. And we also have the prospect of the US Congress bringing a massive infrastructure and spending package fairly soon. Now, the wild card in this equation is what happens with the German elections, because there is a prospect that we see a center-left coalition get power in Germany. If that happens, that would open the door for more EU integration, more investments on a European level, and that might help the euro stage a brief relief rally.
And finally, let's cross over into the United Kingdom, which also is going to have an extremely busy week regarding data releases. We are expecting employment numbers on Tuesday, followed by CPI data on Wednesday, and of course, retail sales out on Friday. Given that the Bank of England appears to be on the brink of ending its QE program, can the data tip the scales in that direction, and how will the pound respond?
I think so. So in England, there has been a lot of attention this week on the tax increases that Prime Minister Johnson is trying to push through. So he's trying to increase taxes on workers to pay for healthcare and social care, and all of the headlines are about that. But the real headline for me was what the Bank of England governor said. And Andrew Bailey essentially told us that at the last Bank of England meeting, policymakers were split evenly 4-4 on whether the conditions for a rate hike had already been met. Now, that doesn't mean they're going to raise interest rates next month, but it does mean that they will most probably end their quantitative easing program this year. And it also suggests that we might see a rate hike sooner than the markets currently expect. The first rate hike is priced for August right now, next year. So long story short, I think that the outlook for the pound is also quite positive. But in the near term, the pound is going to have to grapple with the risk of a spike in unemployment because the government's furlough program is ending. That might see a lot of workers, lose their jobs in a sense. But I don't think this is a huge risk because the economy is already overflowing in open job positions. So even if this risk materializes, it will probably get resolved by itself fairly soon.
Marios, thank you very much for joining me today. This was the Weekly Outlook here at XM.com.